Hello and welcome to PQ Prime. You're watching Talking Point, and my guest today is Abhay Agarwal, founder and fund manager at Piper Serica Advisors. Um, Abhay, thank you very much for joining us on PQ Prime. Let me begin with the markets. You've been quite bullish on small caps and mid caps compared to the large caps. Um, how do you justify that bullishness given the fact that we have seen negative returns coming from small and mid caps?
Yeah. Thank you, Sajid. Thank you for having me on the show. Great to talk to you. So you're absolutely right. Over the last 6 months, our tilt has moved more towards small and mid caps. And the reason for that is that we are seeing more value in that space. And for probably precisely the reason that you said, that because of the muted returns from mid and small caps over the last couple of years, the investor interest is low, and I think that gives us an opportunity to buy into some of these small and mid caps. So I'll give you some examples. We have got companies that are small in size by market cap, but they are leaders in their fast growing spaces or industries. If you look at some of the home builders companies in plywood or MDF boards or some related items, and then you have small financial services companies that are growing pretty rapidly now after having restructured their balance sheets and distribution and CASA and everything. So like that, what we are seeing is that there is a whole host of companies that are neglected by the market, but after research, we can say that look, these companies will grow at 20 to 25% CAGR over next 3 years, if not 5 years. And these are the companies that are now trading at their cyclical low multiples of 15 to 18 times. So we see more value in this space. Obviously, the mid and small cap in space is also rife with risks. These are very small companies, not yet stable compared to the large caps. But if you get those calls right, I think there's a high probability that the mid and small cap space will beat or outperform the large caps over a period of time.
It's interesting that what we have seen is that one of the biggest challenges getting to small and mid cap is the lack of liquidity for exits. And that's one of the reasons why and we saw that happening a few years back when we saw the small cap and mid cap rally, and suddenly the market turned, and when it came for exits or liquidity, it was very difficult, and we saw a sharp correction, and it was as if there was no demand for those kind of stocks. In such a scenario, how do you balance your portfolio and ensure that the companies that you are getting into, whether even if they are 15 to 25% annual growth rate, they have enough liquidity and you have easy exits coming in?
Yeah, that is a very unique problem with these companies. You look at companies which have a 2,000 crore market cap to 10,000, 12,000 crore market cap, and the daily liquidity is not that much. So the risk always is that as an investor, you pay a high impact cost both while buying and while exiting, and especially if the exits are forced exits, then the price correction can be quite severe. So that definitely is a risk. But Sajid, on the other hand, our experience also has been that as these companies grow their market cap, the liquidity starts increasing. So what you need to do is not look at these as trading opportunities, but look at them as long buy and hold and be able to live through the volatility. So I'll give you an example. We have Apollo Hospital in our portfolio for maybe more than 10 years. And then when we first invested in it, it was close to being a small cap. Then it became a mid cap. Then it became a large cap, and now it is part of Nifty 50. So we have lived through that journey. I'm not saying every company will go through that journey, but we have seen enough instances where, as the market capitalization increases, the liquidity increases. But in the short term, that definitely is a risk. And as part of that risk mitigation strategy, what we do is we when we are investing in these companies, we track their weekly delivered volumes. And we do not want our positions to be more than 2 weeks of delivered volume. So in other words, if we were to exit these companies, we should be able to exit them in 2 weeks of trading without incurring much impact cost. So that's the strategy that we have. 75% of our portfolio is made up of mid and small caps, and 25% is large caps. And I think as active managers, it is our responsibility to take these risks and create that alpha return for investors, which will come by making these bets. I mean, I don't think they will come by investing in overpriced large caps.
How do you go about doing selecting this? You mentioned the fact that you're looking at some of the companies, 15 to 25% annual growth rate, but there are only a very select companies in that. It requires deep research as well. How do you go about selecting that, and what kind of model portfolio do you have currently?
So I think that is where a lot of research comes into play, and research which is a lot of secondary research. So when we look at a company, and we have an active universe of around 75 companies that we track regularly. And when I say we track regularly, it means that we meet the management, we meet their competitors, we meet their customers, we meet their suppliers, distributors, to see, is the story stacking up? Is everything is as per our thesis? And at the end of the day, our business is to take risks. So we take that calculated risk when we make, when we add them to our model portfolio. And you're right, our investment strategy is based on a model portfolio that we calibrate not very often, but at least once in a quarter. So in our model portfolio, we have 21 companies as of now, out of which 16 are mid and small caps. And in terms of allocation, we do not allocate more than 5.5% to a single company, or less than 3% to a single company. So that is how we manage the liquidity risk and the market risk by making sure that we are adequately diversified, not over diversified, but not too much invested in a single stock. And in terms of finding these companies, Sajid, it is the classic old-fashioned research, where we have a research team of 4 analysts that goes around, surveying the markets that these companies are present in, constantly looking at, what are the trends, customer demand. We talk a lot to the customers. For instance, we are looking at a company which is into EV space right now, and we are doing a full market research of why would a customer buy this EV compared to any other EV. So I think that is where we build our confidence that yes, it is a long-term bet that we are doing.
Among sectors, I understand that you are bullish on financials, and in the last 2 months at least, you have added a couple of financial small banks into CSB, being one of them, South Indian Bank being one of them. How do you see this space of financials growing? Because we saw financials doing well last year. Do you see enough growth and headroom for many of the small and small cap or mid cap financials to grow?
So Sajid, this is, it's almost cliched now. I don't need to repeat it that, look, if the economy has to grow by 7-8%, the financial services industry will grow at probably double of that. And then you look at where are the best bets in the financial services space. So you have the whole of large caps and large NBFC space that is trading at anywhere between 2.5 to 3 times book value. Growing rapidly, we saw in HDFC Bank's numbers, we'll see probably in ICICI and other bank numbers also that the growth will be there. So it's not that their growth is slowing down. And then you have a whole host of what I call small private banks, small NBFCs, microfinance companies that are valued at probably anywhere from 0.75 times to 1.5 times book value, and are growing probably faster. And the reason for the growth is a management change. So, Sajid, from experience, if you go back, you look at financial services, small banks made a lot of return for investors is when a significant leadership change took place. And we saw that when Ramesh Sokti took over IndusInd Bank and took it to the next level. We saw it when, in RBL Bank's case, Vishwabir Ahuja came in. And then we saw it in the case earlier of Centurion Bank of Punjab, if you remember, when Rana Talwar took it over. So there have been instances of that. So we are driven in the names that you mentioned, CSB Bank, Pralay Mandal coming in from Axis Bank, very capable of setting up, creating a large retail bank. Then we have South Indian Bank, where Murli Natarajan came in from ICICI Bank, has turned around the bank beautifully. We have Spandana Spurti, where Shalabh Saxena has come in from IndusInd Bank. So what we are doing is we are saying that, look, these are great franchises by themselves, but what is the trigger? And the trigger here is the management change. Somebody coming in from outside, reorienting the culture, reorienting the aggressiveness of client acquisition, of growth. So and at the same time, the hygiene factors have to be there. You should have a sticky CASA deposit base. You should have very good lending practices. You cannot ignore that, because in financial services you get into trouble not because of, for the single reason that your asset management or your credit quality deteriorates. So as long as that stacks up, I think these smaller players will create more returns than the larger players. This is our bet, that they will grow, the multiple will expand, and also the market cap will increase faster. I mean, you look at some of these banks, they're at 4,000 to 5,000 crore market cap. So I think it's easier for them to get to, with good execution, 15, 20,000, 25,000 crore market cap. We also foresee a lot of M&A activity going forward in this space. IDBI Bank is already up for sale. We believe that a lot of other M&A will take place, which will drive value for the smaller banks. So, Sajid, that is our bet, that we are looking at this rather than the.
I was coming to that M&A part of it. If Fairfax gets in, then they have to merge CSB with IDBI Bank. How do you see that combination?
I think it will be a very, very solid combination. I'm not sure because it's still a competitive situation.
Yeah, I'm just saying it's a probability.
Of course. Yeah, no, of course, because I think when you have senior management that has seen scale of maybe 20 times of what they are seeing now, then it makes sense to look for acquisitions that rather than organic growth, because organic growth you will get, but it's a very competitive space again, so it is better if you have a strong financial shareholder like Fairfax that can fund the acquisition. And then suddenly you go from being largely a South Indian gold loan bank to being a national level corporate plus retail bank. So I think that will be an amazing transformation. I think the management team of CSB Bank is completely up to the task. So it will be quite interesting to see how that plays out.
What about other sectors? Which are the other sectors that you're looking at? I understand financial was one of them, but in the other in the consumption space, do you still see bullishness in the consumption space? We are seeing slowdown there coming in, especially from rural areas, though urban is coming back in terms of demand. In the consumption space, you mentioned something like the plywoods and the boards where you have like green panel, where you have taken up as part of the model portfolio. But is there any other space which is looking interesting for you?
Yeah, so I think we are seeing through our on ground research, we are seeing that customers are ready to pay a slight premium for a brand. So I think the unorganized players that sell for cheap but lower quality, they will always be there. But I think that is a shrinking market share. What we understand from the dealers and distributors is that now when home buyers or home renovators are renovating, they are willing to pay a slight premium for a good brand. And I think that's where we are saying that there are companies, small cap companies like Green Panel, you mentioned, that is a leader in MDF boards, that has been beaten down in terms of valuation because of different concerns about cheap import of MDF boards plus slowdown in consumption. We are not really seeing any slowdown in consumption. I think the import threat will always be there. But at 16 times, 17 times, multiple to get a market leader like that, I think it's an interesting bet that we have made. And also, we are seeing the similar demand for PVC pipes, PVC fittings, especially in rural areas. And that's where we have added Apollo Pipes to our portfolio some time back, because though it is a very small player in the overall plastic pipe industry, in the plastic fitting industry, it is trying to take leadership. These are the PVC taps, which are anywhere from 30 to 50 rupees that sell in rural areas. And there is a demand for that compared to 10 rupee taps that break regularly. So I think there is a transition that we are seeing, that customers are willing to go for a better brand as long as it gives them more convenience. And it is they started understanding the value for money equation, that look, if I'm paying more, it will last longer and it will be more comfortable. So rather than buying something cheap that breaks, let me pay a little more. So I think we are backing that trend there, that people will, and we are not, again, whatever talks we have with dealers and distributors for these items, and everything pretty much in home building and home improvement, we are not seeing any slowdown in demand. I think the B2B demand has been a little slow for some time, but the B2C demand is still pretty robust. People are still spending for home improvement. So that is other space. The third space that we are being pretty bullish on is the whole capital market infrastructure space, which is companies like CAM, CDSL, Angel One, that have been in our portfolio, because we believe that as the market cap goes from $3 trillion to $6 trillion and new investors come in, these companies have already created a leadership position in their space, and it's almost monopoly and very high margin cash generating business, where they keep giving back a lot of cash to investors. So that is the other, you can say, digital consumption space that we are quite bullish on.
In your model portfolio, when it comes to manufacturing, how are you seeing some of the companies with respect to capex? Because that's something which everyone is talking about. I want to get a sense of in the small and mid cap space, whether there is capacity expansion which is happening at that level, because we've been talking about a large companies doing capex and all, but how are the small and mid cap companies doing it?
So that's a very interesting question, Sajid, because till 3 months back we were also not very clear. But now I would tell you that whatever conversations we are having with these companies, they are already either started capex plans or are looking to get into it. There is more confidence, and the balance sheets are cleaner. So it's not that they have to leverage a lot. There's some companies that we met that already have sitting on 300, 400 crores of cash and net cash, and looking at a small capex cycle. I don't think anybody is looking at doubling the capacity or even increasing the capacity by 50%, but they are looking at increasing the capacity by 20-25%. That's the sense that I'm getting. And these are companies that are leaders in their spaces. They have far better visibility and far cleaner balance sheets to be able to go for a capex. We are not seeing that in very small companies or challenger companies. I think they will follow what the leaders are doing and then probably get into a capex cycle if they see the leader being successful. But the leaders in these kind of spaces are definitely starting their capex cycle.
What about consolidation in this space? Because when you look at inorganic growth, and we look at the organized and unorganized sector, the smaller and mid cap companies are the first one to consolidate their positions before the large ones come in and take over. Are you seeing a shift from unorganized to organized in the way of consolidation by small and mid cap companies, and that's where the growth is coming from?
I think it would happen, but I think a lot of these companies we are talking to are happy to do their own capex and increase capacity rather than acquire a small player, because the manufacturing is still very fragmented. It's all over the country. The plants that unorganized guys run are pretty old. So there is always this concern that how much will I have to spend to spruce up the plant and make it to my standard. So what we are seeing is that there is not much talk of an M&A, and I don't think even the unorganized players are so desperate that they want to sell out. So they will continue to do what they are doing, but the bigger guys will focus more on capex rather than acquisition right now.
You've been not so bullish on the large caps, especially front lines like Reliance, Bajaj Finserv. What is the reason why you're not bullish on them? Because you've reduced that them from your core model portfolio. You don't see enough growth coming in 23-24 for them?
No, I think these are great companies, and when we reduced our allocation from 35% to 25% of large caps, we had to take the call on which companies we let go, and these are the two we decided we will let go. And in case of Bajaj Finance, Bajaj Finserv, it was more a valuation-driven decision because if we are adding smaller banks and smaller NBFCs, then it kind of made sense for us to exit Bajaj Finserv. I think it's a great company, very well run, will continue to grow, but the valuation at 6 times book kind of makes us wonder how much return we will make there as active managers. In Reliance, again, a great company, phenomenally well run, but there are some moving parts. So we would probably look at entering it at another time. For the time being, we wanted to create room to accommodate the small caps that we are adding.
What about the big play, which now everyone is talking about, the new energy, alternate energy play,
Yes.
which is there? I know you spoke about that you're looking at one of the EV companies, but from a new energy and alternate energy play where Reliance is getting into it, other groups are also getting into it. Are you looking at those plays as well?
No, we will definitely look at it. I think that is a future, and it's not just the governments or multilateral agencies that are driving the growth of green energy. I think it's from a cost perspective also now it's stacking up. So we are very open to looking at that. Yes, we are assessing which are the global models that will work there. We want to see large companies like BP, Shell. They are getting into that space. We want to see what kind of models they are following, how fast is the growth. I think there is plenty of time to let that whole ecosystem evolve rather than jumping the gun. But definitely money will be made in that space. I mean, there's no doubt.
Finally, Abhay, you look at small and mid cap very closely. What should be the time period for investors when they look at small and mid cap? Because we see the maximum amount of volatility happening in this
Yes.
segment. So, what should be the time period for them?
Yeah. So when we look at Sajid, investing in mid and small caps, our time horizon is 3 to 5 years. We do not want to exit them before 3 years. And you're absolutely right. I think a lot of people invest in good mid caps, small caps, and then exit when the market volatility hits them. And these spaces are more volatile, as you said. There is a high impact cost because of low liquidity. So when investors buy these up stocks, they should be ready to deal with the market volatility. I think the market volatility should not shake their confidence. And that is why I say that that is what we say. We tell our investors, look, we are taking almost a private equity approach to investing. So for most of the time we forget that these stocks are listed, and because they are listed, but the value is getting created, and that value and price mismatch will always take place in this space more than the large caps. So with that caveat, I think any investor who's investing in this space should look at a 3 to 5 year holding period.
Abhay, it's been a pleasure talking to you today. Thank you very much for joining us on Talking Point on BQ Prime.
Thank you, Sajid. It's been my pleasure. Thank you for having me.
Bye.